What is ESPP capital gains tax? If you are part of an employee stock purchase plan, you might be wondering how capital gains tax affects your earnings when you sell those shares. Let's break it down in a straightforward way. When you buy shares through an employee stock purchase plan, you often get them at a discount, usually around 15% off the market price. This discount is considered part of your compensation and is taxed as ordinary income. But the tax implications depend on how long you hold those shares after purchasing them. There are two main types of sales: qualified dispositions and disqualified dispositions. A qualified disposition happens when you sell your shares at least 2 years after the offering date and at least 1 year after the purchase date. If you meet these criteria, the tax treatment is more favorable. For qualified dispositions, you will pay ordinary income tax on the lesser of the discount based on the market price at the offering date or the actual gain between your purchase price and the sale price. Any additional profit beyond that is taxed at the long-term capital gains rate, which is usually lower than ordinary income tax rates. If you sell at a loss, you may have a capital loss that can offset other gains. On the other hand, a disqualified disposition occurs if you sell your shares before meeting those holding periods. In this case, the entire gain, which is the sale price minus the purchase price, is taxed as ordinary income. This often leads to a higher tax bill since you miss out on the benefits of long-term capital gains rates. To calculate your capital gains tax, you need to know the difference between the sale price and your adjusted cost basis. Your adjusted cost basis includes your purchase price plus the amount taxed as ordinary income from the discount. If you hold the shares for more than 1 year, long-term capital gains rates apply. If you sell them sooner, short-term capital gains rates, which match ordinary income tax rates, will apply. When planning your finances, consider the timing of your sales. Holding shares long enough can reduce your tax burden, but it also exposes you to the risk of stock price fluctuations. Selling immediately after purchase can avoid market risk but usually results in higher taxes. Finding a balance between tax savings and risk tolerance is essential for maximizing your income through employee stock purchase plans. Tracking your purchase dates and understanding these tax rules can help you plan your sales strategically. This way, you can minimize taxes and keep more of your hard-earned income.